What if the real reason most people fail at investing has nothing to do with knowing how to pick great stocks or spot market trends? What if it actually comes down to something a lot harder to measure, something most people overlook? Warren Buffett, one of the most successful investors in history, believes it comes down to basically one thing: how well you keep your emotions in check. Despite building a fortune worth well over $100 billion through decades of consistent investing, Buffett insists that raw intelligence is not the secret to success. He's worked with some of the smartest minds in finance, Ivy League grads, analysts, and economists, and he's still seen them fall flat. Why? Because according to him, the real edge in investing isn't IQ, it's temperament. And when he says temperament, he's talking about emotional stability or level-headedness, patience, and discipline. The ability to stay calm and rational when everyone else is panicking, or when the market is moving in ways that make your stomach turn. Most people don't think about this when they start investing. They want the hottest stock tip or the perfect strategy. They want something that could make them rich right away, rather than something that is near guaranteed to make them rich over a long period of time. But Buffett believes that what separates the winners from the losers is not their ability to crunch numbers. It's their ability to stay calm, cool, and collected, especially when things get tough. He summed this up in one of the most famous quotes: "The most important quality for an investor is temperament, not intellect." That sounds simple, but it couldn't be more true, and it points out why so many people don't succeed. It's easy to assume that the more intelligent someone is, the better they'll be at investing. Maybe they can run calculations, spot trends, get better returns, and far exceed market returns. After all, smart people understand balance sheets, they can do difficult math, they can analyze trends. But Buffett has often said you only need to be reasonably smart to do well as an investor. You don't need a 160 IQ or an MBA from Harvard. In fact, being too smart can sometimes hurt you, especially if it leads to overconfidence or the belief that you can outsmart the market every time. There's a great example of this in the story of a company called Long-Term Capital Management. This was a hedge fund run by some of the brightest minds in finance, including Nobel Prize winners. They had advanced mathematical models that were supposed to make their investing bulletproof, but when markets moved in ways their models didn't predict, they panicked. They doubled down on their risky bets, and the fund eventually collapsed. It wasn't a failure of intelligence, it was a failure of temperament. Meanwhile, Buffett just kept doing what he always does, investing in solid companies at reasonable prices and holding onto them. He didn't try to time the market or bet big on short-term plays. He just stayed calm, stuck to his process, and waited. That ability to wait, to be patient, is one of the core traits that make up great investing temperament. And Buffett has been saying this for years. One of his most famous lines is, "The stock market is a device for transferring money from the impatient to the patient." That hits hard because it's so true. Most people don't fail because they pick bad investments. They fail because they can't sit still. They panic when the market dips and rush to sell everything in an attempt to cut their losses, often after most of the damage has already been done, meaning they end up selling near the bottom. Then, when things are going well and prices are rising, they get greedy and start buying more and more at the top. They obsessively check their portfolios every day, reacting to tiny fluctuations as if it's a matter of life or death. But Buffett plays a different game. He buys stocks with the intention of holding them for decades. He's owned Coca-Cola stock since the 1980s. He didn't buy it for a quick flip. He bought it because he believed in the company's long-term value, and then he let time do the work. He buys a stock with the intention of holding it forever. That's what compounding is all about, letting small gains build over time into something massive. But compounding only works if you can resist the urge to constantly interfere. Patience is boring. It doesn't make headlines. It won't impress your friends at parties. But Buffett knows that real wealth isn't built in months. It's built over decades. And that's where most people mess up. They want fast results. They chase the next big thing. They panic when their investments drop 10% and sell at the worst possible time. Then they jump into something new, hoping to catch the next wave, only to repeat the cycle all over again. That's where discipline comes in. Discipline means sticking to your plan even when it's hard. It means not getting swept up in the hype or fear and not always getting the best returns. Buffett is incredibly disciplined about what he invests in. He only buys businesses he understands, with strong fundamentals and good leadership. He doesn't chase trends. He doesn't jump on every new tech stock just because everyone else is. Remember the dot-com bubble? In the late 90s, tech stocks were exploding, and people thought Buffett was out of touch because he wasn't investing in them. But when the bubble burst and those stocks crashed, Buffett came out ahead. He had the discipline to stay true to his strategy, even when it wasn't popular. And that's a huge part of why he's been so successful for so long. It's easy to have a strategy when the market is calm, but the real test comes when things get messy, when your portfolio is down, when everyone else is panicking, when the news is all doom and gloom. That's when most people abandon their plans. They sell low, buy high, and let emotions take the wheel. Buffett's advice? An investor needs the ability to ignore the crowd and stick to their own game plan. Without discipline, even the best strategy will fall apart the moment the pressure hits. The market is emotional. It swings based on fear, greed, hope, and panic, and it brings all those feelings out in investors too. Fear makes you sell too early. Greed makes you buy things you shouldn't. Impatience causes you to constantly jump from one strategy to another. For example, let's say you notice a friend running a successful restaurant, so you leave your current career and decide to open one up yourself. But when progress is slow and the profits don't come quickly, you get discouraged. Instead of sticking with it, you give up and switch gears to start a landscaping business, repeating the cycle all over again. It's pretty easy to see how this wouldn't work. Buffett once said, "It's not greed that drives the world, but envy." That's such an underrated insight. It's not just about wanting to make money, it's about seeing someone else making money faster than you and feeling like you're missing out. That's what leads people to take stupid risks, jump into speculative plays, or abandon long-term strategies for short-term thrills. Buffett avoids that trap by staying focused on risk. He doesn't try to maximize every dollar. He tries to protect the downside. His most famous rule is, rule number 1, never lose money. Rule number 2, never forget about rule number 1. That's not to say he's never lost money, but it means he invests with caution. He keeps a margin of safety. He avoids bets he doesn't fully understand. That's emotional control. It's knowing that you don't have to chase every opportunity. We saw this play out during the 2008 financial crisis. The market was in chaos. Banks were collapsing, and people were terrified. What did Buffett do? He started buying. While most investors were pulling their money out of the market, Buffett invested billions in companies like Goldman Sachs and Bank of America. He didn't panic. He saw opportunity where others saw disaster, and those investments turned out to be incredibly profitable. Now here's the question. If you had the same information Buffett did back then, would you have made the same move? Would you have had the emotional strength to invest when everyone else was running for the exits? Most people wouldn't, and that's the point. It's not about what you know, it's about how you act under pressure. A classic example of why emotional investing backfires is when people pull their money out of the market after a big drop, thinking they're dodging more pain. But here's the thing. The best days in the market tend to come right after the worst ones. In fact, 7 of the market's 10 best days happened within just 2 weeks of the 10 worst days. If you get spooked and pull out after a crash, you didn't just miss the bad, you likely missed the recovery too. JP Morgan ran the numbers and found that staying fully invested in the S&P 500 over a 20-year stretch would have earned you about 7% per year. But if you missed just the 10 best days, your return dropped by half. Most of those days, right after major downturns. So when Buffett talked about the temperament, staying cool when everyone else is panicking, this is exactly what he means. It's not just good advice, it's the difference between growing wealth and missing out. To be a better investor, focus less on knowledge and more on temperament. Create a long-term plan. Write it down and stick to it no matter what happens. Automate your investments, check your portfolio less, and remember that market drops are completely normal. Buffett's edge isn't just in picking stocks, it's his patient and emotional control. If you want to invest like him, don't just copy his picks, copy his mindset.